What the market wants, the market gets. Stock markets can force the Fed into cutting rates, but only the bond market can bully investors and policymakers alike. In fact, it is the biggest bully on the block, and it can intimidate anyone and even push politicians out of office. Just ask the United Kingdom. For this reason, bond investors are also known as vigilantes. As one analyst noted, if policymakers won't regulate the economy, bond investors will by using the credit markets. The recent move up in yields is significant for a lot of reasons because all sorts of borrowing costs are tied to benchmark rates like loans, credit cards, mortgages, and most of all, the U.S. pays over $1 trillion a year to service its interest payments to bondholders. That's more than it spends on national defense. The fact that stocks, bonds, and the dollar have been weakening at once suggests that investors are losing confidence in U.S. assets. In nominal terms, the $36 trillion U.S. Treasury market is larger than the economy itself. So it takes a really big buyer or seller to move yields. And both Japan and China are the two single biggest holders of U.S. debt. So if you pick a fight with U.S. creditors, they can inflict real pain. And when those rates rise, consumers and businesses will feel even more pain. America's largest export is its financial assets, and it covers a multitude of sins, including massive trade and fiscal deficits. So if international investors decide they don't want to buy U.S. assets anymore, fasten your seatbelts.